Managing your trade credit insurance program between renewals. Most policyholders treat TCI as an annual exercise. Renew, set limits, respond when something breaks. In a market where underwriter appetite shifts faster than renewal cycles, that posture creates hidden exposure. This episode gives you a structured mid-program review framework. Here's a scenario that is not hypothetical. Your TCI renewed in the first quarter. It's now July. A buyer in manufacturing just had their approved credit limit cut by 40%. You're still shipping at the old level. The gap between your live exposure and the new approved limit is uninsured, and you have no idea it exists. This happens every quarter to policyholders who haven't built a mid-program review into their process. The core problem is a mismatch between two cycles. Your TCI is a 12-month contract, but the risk environment it covers moves on a completely different clock. Carriers adjust buyer limits continuously, informed by sector-level payment behavior, trade lane stress, and signals your individual team never sees. A limit cut in March on a buyer you review in October is 4 months of potential uninsured exposure. The 2024 to 2026 tariff and geopolitical environment has accelerated the pace of these reassessments significantly. The fix is a 3-checkpoint mid-program review. Checkpoint 1, AR to limit reconciliation, comparing your live accounts receivable against current approved limits for every covered buyer. Checkpoint 2, an Elevated-Scrutiny Sector and Geography Scan, cross-referencing your buyer book against sectors and trade lanes currently under underwriter pressure. Checkpoint 3, proactive limit management, requesting increases before you need them, because retroactive coverage doesn't exist. Let's walk through each one. Checkpoint 1 is the AR to limit reconciliation. Pull your current accounts receivable aging by buyer, then pull the current approved TCI limits for each of those buyers and compare them. Flag any buyer where your live exposure exceeds the approved limit. Flag buyers where a limit has been reduced since your last check. Run this at a minimum every quarter, monthly for high concentration or high scrutiny buyers. The key point, uninsured exposure above an approved limit does not disappear because you haven't looked at it. It accumulates silently until a shipment defaults. Checkpoint 2 is the sector and geography scan. A buyer's individual credit history is not a complete picture when their sector or geography is under broad underwriter pressure. Take your buyer book and cross-reference it against sectors currently seeing elevated scrutiny. Manufacturing, construction, consumer goods, retail have all seen tightening in recent quarters. Then ask your broker directly, have you seen broader limit tightening in this sector or for buyers in this region in the past 90 days? Your broker has visibility across the carrier's entire insured population. That's market intelligence you cannot get on your own, and a good broker surfaces it proactively. Checkpoint 3 is proactive limit management. This one is non-negotiable. Retroactive limit increases do not exist. You cannot get coverage backdated for shipments you've already made above an approved limit. If a buyer is approaching their current approved limit, request an increase before you need it. Support that request with current documentation, financial statements, payment history, trade references. A proactive request that gets approved gives you headroom and leverage. A reactive one filed under time pressure, with shipments already in transit, rarely ends well. The broker relationship is central to making this framework work. 3 questions worth a mid-year call with your broker. Which buyers in my book are you seeing limit pressure on across the portfolio? Which sectors are carriers tightening on right now? And are there endorsements or extensions I should be considering given current conditions? If you only talk to your broker at renewal, if you find out about limit changes when they affect a shipment, if no mid-year program review has ever happened, those are signals that the relationship is too transactional to add real value between renewals. 4 warning signs that your program needs immediate attention. 1. You have not reconciled your AR against approved limits in more than 90 days. 2. A buyer in a tariff-exposed sector has not had their limit reviewed since 2024. 3. You have buyers with LATAM exposure and you're uncertain whether your policy includes a political risk extension. 4. You have received limit reduction notices and treated them as administrative paperwork rather than as credit risk signals that require a response. Any one of these warrants a review before the next shipment, not at your next renewal. If your TCI program has not had an active review since it was placed or last renewed, and the risk environment has shifted materially since then, which it has, that review is overdue. The full mid-program review framework is in this week's blog at impelloglobal.com. If you want to walk through it for your specific accounts receivable book, reach out to Impello directly at info@impelloglobal.com. Subscribe for weekly trade credit content every Tuesday.